Are we talking about it? And should we be talking about it this morning? How significant is it?
We're going to be talking about it one way or the other. Look, I think this is important. The Fed is likely to start to shift their policy stance in the coming months. It's not unrealistic to think you begin tapering in Q4. Having said all that, despite all the ink being spilled, a couple of points. Long-term yields have actually remained remarkably contained. We've never taken out the high from back in February and March. Bond market volatility is down significantly from where it was, again, back in February and March, despite the biggest inflation print in 40 years. So this is a big deal, but, the wheels are not coming off the vehicle yet. And I think that's important to realize. We still have a 165 10-year. Bond market volatility right now is still modest. So as of today, that helps explain why stocks are only down 3-4% from their high.
I mean, the correction has been a non-correction. Russ, can you buy the big techs here? Have they been unloved for a long enough time where they're actually a relative value of relatively unloved?
I think there are some opportunities in the big tech. Just to be clear, we're talking about, I think it is the mega cap, high quality tech. It's not necessarily the more speculative names, the ones where earnings are 5 or 10 years out. We've actually been trimming those from the portfolio. But yes, if you're talking about high quality tech, it may underperform over the next 1 to 2 quarters if we get these gaudy GDP numbers and the cyclical trade continues. 2-3 years out, I think you want to own them. You want them in your portfolio.
Meanwhile, as we talk about portfolio construction, Russ, there is a question of whether treasuries can provide truly a hedge for equities at this point, especially given the negative correlation that's gotten it, by one measure, to the most since the 2000s. What's your sense right now, early 2000s, I should say, what's your sense of how hedge-worthy treasuries really are?
Right now, not much. The reality is things have changed. And if I look at stock-bond correlations, everyone knows they're ticking up. What's been less discussed is the fact that equity market volatility has remained elevated compared to bond market volatility. That wasn't a couple of months ago, but the reason that's important, the reason it's affecting the efficacy of the hedge, is that tells you how convex a hedge it is. What you're seeing is even in these days when the market is down a couple percent the way it was last week, either bonds are flat or they're up a little bit. They're not giving you that big movement that made them such an efficient hedge the way they were a couple of years ago, and that's a big change. We don't talk about that a lot. We talk about Bitcoin. We talk about the Fed. If you're building a portfolio, the degradation and efficacy of bonds as your primary hedge is a big deal.
Just to be clear here, Russ, you were the first person to mention Bitcoin on this program so far this morning. 10 minutes in. Just to be clear about that. Russ, just finally and quickly, are you still nursing that cash position? Do you still sit on that going deeper into summer?
We do have the cash position. Again, it's the flip side of that being very underweight duration. Everyone's got a volatility they look to manage their portfolio to. In the absence of duration, you need other hedges. Part of it is cash. There are other things as well. There's vol as an asset class. There's FX pairs. But in a world where you're not getting that convexity from duration as a hedge, you're going to run with more cash.